Okay, in Chapter 2 we're going to go over quite a few basic concepts that you'll need throughout the rest of the managerial accounting course. Alright, first thing we're going to do is define cost. Cost is a term we use all the time, but let's be a little more formal about it and define it. We're talking about the amount of cash or cash equivalent sacrificed for a good or service that brings a current or future benefit to the organization. So, seems simple enough, but remember that cost does not always have to be money. So we can measure cost sometimes in terms of time, we can do barters for things, so that's how we're going to use the cost term. The meanings and uses of cost. Okay? Costs are considered to expire. So expired costs are called expenses. So in other words, if I buy inventory, like some supplies, let's say I buy some supplies in my supply cabinet, like pens and pencils and things to use in the office. Those are considered part of my cost of doing business, right? I have things sitting around that I'm going to need. When I use them up, they're considered expenses. So they are used in the business and therefore go against the revenue that we generate in the business. So back in our income statement, you remember from financial accounting, we deducted those expenses from our revenue to figure out what our net income is. Okay, so two terms so far, cost and expense. Third term we're going to look at is price. When we talk about price, we mean revenue. So be very careful when you use the term price and cost. Sometimes people try to interchange them. But the cost inside our company is what we've spent for something to acquire it. The price is what we're charging the customer. So what we have to work on for managerial accounting is how we want to track those costs. And we start by talking about cost accumulation. Okay, when we accumulate costs, it's the way that we measure them and record them. So in other words, what kind of buckets or categories are we going to put our various costs in? So we may be in charge of the phone bill. The phone bill comes in, we're going to record it as an accounts payable because we have to pay the bill, and a telephone expense. Now we have some choices typically in how we can record these things and how we can accumulate costs. Once we accumulate the costs, we have to assign them. So we didn't do that in financial accounting, but we're going to do that in managerial accounting. So we have to know what cost object that cost is linked to. When we talk about a cost object, we mean some way that it's important to us for tracking costs. So in this example, we got that phone bill, we're looking to assign the cost. We'd say, well, what did those costs go to support? Were they there to support manufacturing? Were they there to support selling? So we know how to charge off that phone number or that portion of the bill. Because for us, we want to accurately know about our costs. One of the most important reasons is so that we can accurately set our price, but also so that we can measure performance. So a cost object, as its definition, is any item such as a product, customer, department, project, region, for which costs are measured and assigned. We pick. Okay, nobody's going to come and tell us, here's what your cost objects have to be. We get to pick what those cost objects are going to be and try to make sure that they make sense in our business for how we choose to split up our costs. So if we're Target and we have 14 stores in our area, we may assign cost by store. Okay. Within Target, we may decide we want to assign cost by department, so we know whether health and beauty versus clothing is making more profitability or whatever it is that we're looking to track. So we have to figure that out in a way that is meaningful and makes sense for our company. Okay, so we can assign cost to a cost object, quite a few different ways, but sometimes in managerial accounting we have to be very careful that the time we spent tracking something is worth what we get out of that tracking. So in other words, we want to make sure that when we're assigning things, we're not diving so deep in the details that we're creating a whole need for a whole department just to track costs when the difference in tracking them or not tracking them may be very minimal. So we have to be careful. Sometimes in managerial accounting, close enough is good enough, which we don't say ever in financial accounting, but in managerial accounting, sometimes speed and relevance is more important than complete accuracy in terms of dotting every I and crossing every T. So here's some ways that we're going to assign our costs. Okay, direct costs are those that are easily and accurately traced to a cost object. So when we have a direct cost, it's something that we can see, we can observe how the relationship works between the cost and the object. Okay, so if I'm trying to track costs for each of my Target stores, I can see that the cost of snow plowing, the parking lot, is easy to trace to that particular store where the parking lot is being snow plowed. That's an easy cost. The cost of advertising in the area, that's a little bit tougher because it's hard for me to see which store that is directly going towards. Okay, indirect costs are things, again, that can't be easily and accurately traced to a cost object. So it's not clear what that relationship is, so we have to come up with a means to allocate them. Okay, we allocate a cost as a convenient way to do it. So again, going back to that Target example, the cost of the advertising insert, well, if that advertising insert benefited 10 stores, then maybe I just take the cost and divide by 10 and allocate each store 1/10 of it. That's my choice. I may decide to allocate it based on sales dollars. The stores with the biggest sales get the most expense. It's up to me. All right, some other ways we can measure costs, and you'll see throughout this chapter there's a whole lot of ways we can measure costs. We can talk about costs by how they behave. So if you recall back, we did this a little bit in finance and financial accounting. When you split your costs up by how they behave, you start with a variable cost. A variable cost is one that varies with our output. So it increases when output increases, and it decreases when output decreases. So these are things that are tied to the number of units we produce or the number of people that we serve, variable costs. Fixed costs are things that don't change with output. It doesn't mean they don't ever change, but they don't change based on our production of our product or our service. So think about like the lease on our building. It might go up, the charge may go up year to year, but it's not going to go up based on how many customers we have or how many products we sell. And then we have a definition called an opportunity cost. An opportunity cost is when we give up or sacrifice something in order to pick one alternative over another. So if I decide to rent this room out for a training class, I can't hold a class myself in that room. There's an opportunity cost if I had that as a possibility. So we have to think about what we could do with our resources as well. We have product costs. Okay, if we're making a product, that's really obviously what we're most worried about in terms of the cost. We worry about what those costs are that go into products. So we take a product being something where we take raw materials, do something to it, and turn out a product. So some examples: TVs, hamburgers, automobiles, those are all products. Services are things that we do in order to provide a benefit to the customer, but we don't have a thing necessarily that we're producing. So insurance, medical care, car rental, all that kind of stuff are services. So product cost comes from the production section of the value chain. So when we look at product costs, we're talking about those specific things that end up where you can kind of touch them and see them in the final product. We inventory our product costs. Again, remember in financial accounting, when we build stuff, it sits as an asset on our balance sheet until we sell it. When we sell it, it becomes an expense. It becomes cost of goods sold expense. So our product costs, we split into 3 categories: direct materials, direct labor, and manufacturing overhead. Direct materials are those kind of things that we can directly trace to the goods that we produce, so you can kind of see them and touch them. So when we have direct materials, they become part of the final product. So we have, for example, we're making a car, we have a wheel, we have a tire, we have a radio. All those are direct materials that obviously go into the car. Direct labor, we can directly tie to the goods being produced, so we know how many hours somebody spends specifically producing that product. So for the car, we can see the assembly people working on it. So we can physically observe it and measure it. We also may have indirect labor. Indirect labor is called an indirect cost, and it is usually referred to as overhead. You'll hear it. So in other words, the factory has to have a security officer. It has to be there. He's labor, but he doesn't directly touch and affect the cost of the product. So we have to have a way to allocate his cost. Okay, all those things go into manufacturing overhead. So all product costs other than direct materials and labor are considered manufacturing overhead. You'll hear this talked about as burden or indirect manufacturing costs or just overhead. You might hear those terms. We include anything in overhead that is directly tied to the making of the product, but we can't directly trace into the product. So it's not direct material and direct labor, but it obviously goes into making the product. Okay, so we have things like depreciation on the plant buildings, janitorial maintenance, the utilities, the lighting, the heating, plant taxes. So anything that goes into needing, we need it in order to make the product, but we can't directly trace it conveniently. So our total product cost then, we add direct materials, direct labor, and that manufacturing overhead. Take that per unit, we just divide that total cost by the number of units. Pretty straightforward. These are really just a matter of making sure you have the right formulas written down. The math is very straightforward on these. Alright, so here's an example. We have the Blue Denim company that makes blue jeans. Direct materials cost $48,000 were put into production. Direct labor of $30,000 was incurred. Overhead was $72,000. They manufactured 30,000 pairs of jeans. So there's the given information. We're going to calculate the total product cost and then the per unit cost. So the total product cost, again, direct materials, direct labor, and overhead. So we just add the 48, the 30, and the 72, and we get that it costs us $150,000 in direct materials or in product costs to make those jeans. How many jeans do we make? We made 30,000 pairs. So we take $150,000 divided by 30,000, we get $5 a pair as our cost. Pretty simple. All right, another way we can split up our costs is by classifying them as prime versus conversion. So prime costs are those that, think about the word prime, it kind of means the main thing. That's your direct material and direct labor. So prime costs are direct materials plus direct labor. Conversion costs are what it takes to take our raw materials and convert it to the final product. So conversion is direct labor plus manufacturing overhead. So you notice we just leave out direct materials there. The key thing to remember, we can never add prime plus conversion because we'd be double counting direct labor. So these are just knowing the formulas. If I ask you for prime, it's direct materials plus direct labor. If I ask you for conversion, it's direct labor plus manufacturing overhead. But you never add those two together because direct labor is in both of them. Okay, so again, going back to our blue denim, our prime cost then would just be direct materials plus direct labor, $78,000, or per unit, $2.60. And then if we look at what our conversion would be, it'd be $102,000, or per unit, $340. Again, we never add those two together. We wouldn't take the $260 and the $340 to get the per unit cost because we would be double counting direct labor. We can also talk about whether something is instead of a product cost, a period cost. So our product costs were part of the inventory cost, so they went into the asset and sat on the balance sheet. Our period costs are not. They're not carried in inventory, and they are just charged off in the period that they're incurred. So period costs would be things like research and development, CEO, advertising, office supplies. So think of all those things that aren't directly impacting the product. We need them to run the business. We don't need them necessarily to build the product. So that's what our period costs are. Okay, period costs are expensed in the period that they are incurred, and we have to be careful if a period cost is something big. If it's an asset, then we have to capitalize it. Again, remember that from your financial accounting class. So here's how it looks graphically here. We can split our costs into product versus period. If it's a product cost, it becomes an inventoried cost on the balance sheet. It's an asset to us until we sell it. When we sell it, it becomes an expense on the income statement, the cost of goods sold. With a period cost, if it's something we're going to capitalize, if it's the purchase of an asset, then we'll put it on the balance sheet and we'll depreciate it on the income statement. Otherwise, it's just charged directly off as an expense in the period that it happens. We also have selling costs. Okay, selling costs are those things that are necessary to get our products to our customers' hands. So market, distribute, and service a product or service. So we have order getting, order filling, we have warehousing, shipping, customer service, we have salespeople, we have commissions, all that kind of stuff. We also have administrative costs. So these are things like R&D, CEO, things that aren't selling and aren't production but have to happen for the business to run. Okay. So it's the business of the business, I guess, costs. So those are the different categories there. Some examples of the administrative costs would be executive salaries, legal fees, general accounting. Accounting is always administrative costs. All those kind of costs go in as administrative. So here's how we look at some of our costs. If we are in a restaurant, our direct period cost would be the chef's salary. Our indirect period cost would be the disposable napkin. So these are things we're not going to trace directly to the product, but they are something that could be either direct or indirect. Alright, so let's get out of some of those cost definitions and get into how this works on the statements. And again, this should be a review based on what we did in financial accounting, but we got to go back through it. So when we were in financial accounting, we looked at cost of goods manufactured, cost of goods sold. We're going to talk and walk more through that, but this formula down at the bottom of this page is a really good one for you to kind of keep on hand because it comes in handy in a variety of your homework problems and situations. But again, basically it's just knowing the formula and then pulling the information out of the problems. So here we have beginning inventory plus purchases minus direct materials is ending inventory. We can switch this formula around any way we want to solve for whichever piece we need. So we could solve for ending inventory, we could solve for purchases, we could solve for direct materials used, we could solve for beginning inventory. As long as we know 3 of the 4 variables, we can solve for the other one. So we want to figure out what we started with, our beginning inventory, add what we bought, our purchases, and figure out what was left over, or figure out what we used. If we figure out what direct materials we used, we can figure out then what we have left over as ending inventory. If we know what we have left over as ending inventory, we can figure out direct materials used. Okay? So this is, once we have this, we can calculate our cost of goods manufactured. And we're going to need this obviously to prepare our income statement. So let's look at this. Again, back to blue denim, they had 68,000 of materials in inventory on May 1st, so that's your beginning inventory. During the month, they purchased 210,000, that's our purchases. On May 31st, their materials inventory equal 22,000, that's their ending inventory. So we just plug those numbers into the formula we just did. Beginning inventory plus purchases minus our ending inventory gives us 256,000 was our materials used in production. Now, obviously, in a period of a month, we don't always finish up everything that we've started, so we have something called work in process. Work in process are partially completed goods, stuff that we started but didn't finish before the accounting period closed. So work in process have some costs assigned to them, but not all of the costs, so it can get a little bit confusing as to how we treat it. But work in process, we have to adjust the manufacturing costs at the end for work in process, and we'll get into that later. But for now, just remember that we don't finish everything that we start. All right, so here's, again, our blue denim. Asked us to calculate the cost of goods manufactured for the month of May. Gave us that same information, direct labor, et cetera, et cetera. So now what we're going to do a little bit fancier. Direct materials used in production was the 256 that we started with a couple slides ago. We just calculated that. Now we add direct labor and manufacturing overhead so we can get the total manufacturing cost. Okay, so we have 541,000 we put into manufacturing our jeans. But now I need to know, well, how much of that went towards the jeans that are done or not. Well, I had 50,000 that I started with on May 1st, my work in process. I had work in process on May 31st, the ending work in process 16,000. So what I actually manufactured cost me 575,000. So what we're trying to say there is we took into account that we finished some and we had some left over. Okay, our cost of goods sold then is what we actually sold. So now, again, the formula should look familiar. Beginning, oops. Should look familiar. Beginning finished goods plus what we added minus our ending gives us our cost of goods sold. So if you notice, we keep just changing the words in the formula, but the formula is the same thing. What did I start with? What did I add? What did I have left over? So again, with the blue denim, we're going to come up with what the cost of goods sold statement would look like. And look at that. We take the cost of goods manufactured, the finished goods inventory, we subtract what's left over, the ending inventory, we get our cost of goods sold. This is the number then that we're going to put onto our income statement as our cost. We're going to expense that off against our revenue. And then we can go and figure out how many units we had left as well. So if we start with 10,000, we finished 115, okay, there's 115 finished. But look, we have 26,000 still laying around at the end, so that means we only sold 99,000 in the year. Okay, so we can always state, what did I start with, what did I add to it, and what's left over at the end, and I can get the units that I sold. Okay, so here's what our income statement then will look like. Obviously, we're not going to spend too much time on this, you did this in financial, but our revenue minus our cost of goods sold gives us our gross margin. Then we subtract our selling expenses. In this case, we had commission and a fixed expense. We subtract our administrative expense. We get an operating income. And if you recall then from financial accounting, you'd go back through and you'd probably have some interest and some taxes to subtract off at the end and then get to your net income. Okay, so gross margin for a manufacturing term is revenue minus cost of goods sold. So when you hear people talking about, oh, we've got a big margin or not, they usually mean their gross margin. And that's just asking how much money are we making just from the difference between our revenue and our cost of goods sold. So before we get into all those other administrative expenses and everything, how much profit are we making? Okay, so gross margin is not operating income, it's not profit, because we haven't subtracted all the other stuff. But gross margin is the first indicator of whether we're covering our product costs. So let's say I'm Wegmans and I buy a box of Kellogg's cereal from Kellogg's for $1 and I sell it for $1.50. Okay, well right there I know my gross margin is 50 cents. I've made 50 cents on that box. 50 cents isn't my profit. I still have to subtract the wages of everybody and all the other costs associated with it, but at least I'm so far so good, right? I've at least made a profit, a margin profit at that point. All right, so our gross margin is something that we like to compare to the industry to see how we're doing. So if I'm making 50% as a gross margin and my competitors are making 10, I'm really happy. If my competitors are making 10 and I'm doing 4, I probably need to do some work or figure out where they're getting their advantage. So that's one of the things that we look at to compare ourselves to and to try to change how we run our business to be more efficient. Okay, and then we get to operating income. We take that gross margin, we subtract our selling and administrative expenses. Key figure because it shows what we're doing for the company. So operating income, just think of that as the line before we get to the interest and taxes, but really is showing you how the company is doing from how the company is run, not the financing part of it. In a service firm, we don't have the product to worry about, but we have, so we don't have like beginning or ending inventory, so it's a much simpler income statement to prepare, still just as expensive. It's just as important, not expensive, but we don't have to worry so much about all the formulas for the product, the beginning and ending inventory. So this is what a typical service organization looks like. We just have sales revenue, and then we have operating expenses. So we don't have to do cost of goods sold. We don't have all that stuff. We just have revenue and expenses. Much simpler. Okay, so that is the end of Chapter 2. Hopefully you got enough cost definitions to make your head spin for a little bit. Again, just keep the formulas in front of you and you'll be fine.